On Dexy 12, 2025. The U.S. Treasury released its tick report. Inside the figures was a notable shift. China is cutting its U.S. Treasury holdings. Over 18 months, China's holdings fell by about $127 from roughly $860 June 2024 to about $733 November 2025. That's around a 15% drop, and the pace is accelerating. Many analysts focus on the implications for the dollar or interest rates, but another pattern stands out. Over the same 18 months, China's silver imports surged. Chinese customs data shows silver imports rising from about 800 metric tons in 2023 to more than 200 metric tons in the first 10 months of 2025. That's roughly a 29% increase. Put together, China is selling anyone, Treasury's paper assets backed by is full faith and credit while accumulating physical silver. Silver is tangible and has both industrial use and monetary characteristics. The key question is, why do this? And what does China see that others might be missing? The argument is that this is not about short-term returns. The move appears strategic, preparing for a future with a weaker dollar, less appealing treasury bonds, and physical commodities as the real store of value. If true, the implications for silver prices could be enormous. The analysis promises to lay out the evidence, linking treasury selling to rising silver accumulation. It aims to show why this pattern points to much higher silver prices. China has been the largest foreign holder of U.S. Treasuries for more than a decade, but that status is changing. A timeline is used to illustrate the steady downtrend. In 2013, China held about $1, 3 tons in treasuries its peak. By 2016, holdings fell to roughly $1, 1 ton, a $200 reduction over 3 years. In 2020, holdings were near $1, 6 tons, and stayed relatively stable through the pandemic. By 2022, they dropped to around $970, falling below $1 ton for the first time in years. By mid-2024, the holdings slid further to about $860, signaling acceleration. By November 2025, they were around $733, down another $127 in just 18 months. This is described as the fastest pace of decline from the $1. 3 tons peaked to the current level. In total, the holdings are down about $567, more than $500 billion sold over the past decade. The critical question remains, why is this happening? And what assets are replacing those treasuries? China's official line is diversification, balancing its reserve portfolio while reducing exposure to rising U.S. fiscal deficits. They're also concerned about dollar depreciation, which is understandable. But the official explanation leaves out the key issue. Where did the $567 actually go? Reserves don't just disappear. When treasuries are sold, dollars are received and then exchanged for other assets: gold, euros, yen, real estate, commodities, or something else. Based on the data reviewed, a meaningful share appears to be flowing into physical commodities, especially gold and silver. Start with gold. According to the World Gold Council and multiple reports, China's central bank added roughly 300 tons of gold across 2023-2024. At average prices, that's about $18. It's a notable number, but it explains only a small slice of the $567 in treasury sales over the past decade. So where did the remaining $549 go? Some was shifted into other currencies, including the euro and the yen, along with additional reserve assets. Some was allocated into IMF special drawing rights, SDRs. Other portions were invested domestically, such as infrastructure projects and initiatives tied to the Belt and Road program. But the interesting part is that some capital also appears to have gone into strategic commodities. Within those commodities, silver stands out as especially important. The implication is that silver is part of the broader reallocation away from treasuries. Quick disclaimer, this is not financial advice, and the speaker is not a financial advisor or affiliated with anyone mentioned. It's an educational analysis based on publicly available data. Now to China's silver import data from Chinese customs in 2020. Imports were about 200 metric tons, roughly 135 million ounces. In 2021, they rose to around 900 metric tons, about 157 million ounces. In 2022, imports reached roughly 5,000 metric tons, around 164 million ounces. In 2023, they dipped slightly to about 4,800 metric tons, about 154 million ounces, then climbed again in 2024 to roughly 500 metric tons, about 177 million ounces. In 2025, through October alone, imports had already hit 200 metric tons. At that pace, annual imports would exceed 400 metric tons, roughly 238 million ounces, meaning silver imports rose about 76% from 2020 to 2025. That's not random noise. It's a clear, accelerating trend. It becomes even more significant given that China is also the world's third largest silver producer. Industry estimates put domestic mining output near 700 metric tons per year, about 119 million ounces. Combined with imports of around 238 million ounces, total annual silver inflow into China is roughly 357 million ounces. So where is all of that silver going? Official explanations point to industrial demand, solar panels, electronics, batteries, all reasonable uses. China is the world's largest producer of solar panels, with reports suggesting it accounts for around 80% of global solar manufacturing capacity. Each panel requires silver paste for electrical connections. That explanation makes sense. But here's the catch. Silver is essential for modern manufacturing, advanced technology, and achieving energy autonomy. But here's the kicker. The silver market is incredibly small. Estimates suggest that the entire investable supply of silver is only around $50 billion. If China aimed to dominate this market similar to what the Hunt brothers attempted in 1980, it absolutely could. Just a small portion of the funds it freed up from selling treasuries would be enough. In the context of China's $3 plus trillion in reserves, $50 billion is a rounding error. Let's zoom in on the geopolitical side of the equation. Why is China pulling back from treasuries now? The relationship between the U.S. and China has worsened significantly. Tensions surrounding Taiwan are at their highest point in years. Trade disputes continue. Export restrictions on tech and threats of sanctions persist. China watched the West's reaction to Russia's invasion of Ukraine in 2022 very closely. Around $300 billion of Russia's foreign reserves, largely held in dollars and euros, were frozen. Treasury holdings, bank accounts, all locked and rendered useless. Russia discovered that holding dollar-denominated assets gives Washington ultimate control. China took note, and they're determined not to fall into the same trap. If Beijing were to take action on Taiwan, even something limited like a blockade, the United States would almost certainly respond with economic sanctions. That would likely involve freezing China's dollar reserves, severing dollar-based transactions, and removing major Chinese banks from SWIFT. China is aware of this risk and is clearly taking steps to mitigate it. They're cutting back on U.S. dollar exposure and reallocating toward tangible assets, ones that can't be disabled by digital commands from overseas. Gold stored in Western vaults can be frozen, but gold or silver held inside Chinese borders is immune to sanctions. That's the shift underway. I see this process unfolding in 4 key phases. Phase 1, dollar, accumulation 2000-2013. During this period, China ran substantial trade surpluses and accumulated more than $3 trillion in U.S. Treasuries, becoming the world's largest creditor. It was a time of integration into the global economy. China needed dollars to support trade and used treasuries as a secure investment. Phase 2, stabilization and strategic rethinking, 2013-2020. Holdings hovered around the $1 trillion mark. China began questioning the long-term dominance of the dollar, explored alternatives, started building gold reserves, and began to modestly increase silver imports. Phase 3, deliberate divestment and hard asset acquisition, 2020 to present. China has been steadily selling treasuries down from $1.06 trillion to $733 billion in just 5 years, a 31% drop. At the same time, gold purchases accelerated, silver imports surged, and paper assets were gradually replaced by physical commodities. This is the stage we're in right now. Phase 4, decoupling and economic independence, 2026, 2030, projected. By this stage, China is expected to complete its pivot away from dollar reliance, retaining only minimal treasuries and building up substantial reserves of commodities. If conflict erupts, the nation will be far more insulated. This is the strategic endpoint. There's a precedent for this playbook. Consider Russia from 2014 to 2022. After its annexation of Crimea, Russia started to unwind its U.S. Treasury holdings from about $130 billion in 2013 to under $10 billion by 2020. At the same time, it doubled its gold reserves from around 1,000 tons to more than 2,300 tons. They recognized the risk and took action. When sanctions were imposed in 2022, Russia's economy didn't crumble because it held real assets, gold, energy resources, and commodities, not just paper-based financial instruments. During the 1,980 seconds and into the 1,990 seconds, Japan's treasury holdings peaked at roughly $300 billion. But as trade tensions with the U.S. intensified, Japan shifted its strategy, redirecting investments into American real estate, businesses, and tangible assets. The idea was simple: own assets that can't be devalued through monetary policy. More recently, Saudi Arabia has followed a similar path. Over the past 5 years, it has scaled back its U.S. Treasury exposure and redirected capital into infrastructure projects, sports franchises, tech ventures, and reportedly increased its gold reserves. Around the world, sovereign wealth funds are moving away from paper assets and focusing on hard assets with intrinsic value. China appears to be deploying the same approach, only at a much greater scale, with silver playing a central role. But what truly raises concern is the timing. Why is China accelerating its sell-off of treasuries in 2024 and 2025? I believe there are 3 key drivers. First is the U.S. fiscal outlook. The national debt has surged to $36 trillion, with annual deficits approaching $2 trillion. Interest payments on that debt now exceed $1 trillion per year. From China's perspective, the path forward looks unsustainable. They're looking to reduce exposure before a potential crisis unfolds. Second is the shift in Federal Reserve policy. The Fed began reducing interest rates in 2024 and continued through 2025. Lower rates translate into weaker returns on Treasury securities. When inflation is at 3% and bond yields are only 4%, the inflation-adjusted return is just 1%. That's hardly appealing for a reserve asset. In contrast, commodities tend to rise with inflation and offer better protection. Third is geopolitical positioning. Tensions over Taiwan continue to escalate. China's military posture around the island is becoming more assertive, while U.S. support for Taiwan is intensifying. If Beijing is planning any strategic move within the next few years, it needs to ensure financial insulation beforehand. Selling treasuries during peacetime is a proactive strategy, not something you start once conflict begins. The timing points to preparation. Now, let's look at what all this means for the silver market. If China has been steadily accumulating silver for the past 5 years, using proceeds from treasury liquidations to fund those purchases, the underlying supply-demand balance is drastically different from what most investors think. Here's the breakdown. Global silver mining yields around 820 million ounces per year. Industrial use consumes roughly 600 million ounces. Investment demand typically runs at around 200 million ounces. Jewelry and miscellaneous use cases contribute another 200 million ounces. That puts total yearly demand close to 1 billion ounces. This leaves a shortfall of about 180 million ounces annually, usually covered by above-ground inventories, recycling, or government stockpile sales. But if China is importing 238 million ounces per year and producing an additional 119 million ounces domestically, that's a total of 357 million ounces entering China every year. If even half of that silver, around 178 million ounces, is being set aside in reserves rather than consumed right away, then that entire annual deficit is effectively being absorbed by China alone. And that changes everything. The global silver market is running an annual deficit of roughly 180 million ounces, and China alone is absorbing nearly all of it. So, what happens when the largest buyer also starts limiting exports? We saw the first signs of this in late November 2025, when China reportedly began tightening silver export licenses. That action removes additional supply from the global market. In effect, China is pulling metal in through imports, while simultaneously choking off outbound flows through export controls. That's a textbook supply squeeze. And in a squeeze, prices have to rise to ration what's left. Let's walk through a projected timeline. In 2025, the current phase, China holds about $733 billion in U.S. become wide Treasuries, down from $860 billion just 18 months earlier. Silver imports are climbing rapidly. Export restrictions are beginning to appear. Silver is trading around $59, up roughly 85% year to date. The move is already underway. In 2026, the liquidation continues. If China keeps selling treasuries at the present pace, that its holdings could fall below $600 billion by the end of 2026. That would mean another $133 billion in sales. Even if only 10% of that capital is redirected into silver, that's $13. $3 billion in new demand. At an average silver price of $60, that equates to about 222 million ounces. If export restrictions remain in place at the same time, global supply tightens even further. Under those conditions, silver could reasonably move into the $80 to $100 range. By 2027, the acceleration phase. China dropping below $500 billion in treasury holdings would signal an almost complete exit from dollar dependence. Commodity reserves would be substantial. If tensions over Taiwan escalate or an actual conflict breaks out, silver prices could spike dramatically, potentially reaching $120 to $150 as industrial users scramble to secure access to supply. From 2028 to 2030, a new equilibrium emerges. Either a conflict has already occurred and silver stabilizes at much higher levels above $100, or tensions ease and prices correct but remain elevated, likely above $70. In either scenario, the era of $20 silver is effectively over, in my view. Now let's look at the data behind these conclusions. U.S. Treasury TIC reports, published monthly, clearly show foreign holdings of U.S. securities, and China's steady decline is visible to anyone reviewing the numbers. Chinese customs data from the General Administration of Customs provides monthly import and export figures, including precious metals, and those reports clearly show rising silver imports. The World Gold Council publishes quarterly updates on central bank gold purchases, confirming China's ongoing gold accumulation. The Silver Institute's annual reports offer comprehensive global supply and demand statistics, which continue to show persistent deficits. This isn't speculation, it's pattern recognition based on publicly available government data. Finally, let's address the main counter-arguments. The first is that correlation doesn't prove causation. Just because China is selling treasuries while buying silver doesn't automatically mean one is financing the other. That's a fair point. But when a country is simultaneously reducing paper assets and increasing hard asset exposure during a period of rising geopolitical risk, drawing a connection is not unreasonable. It's a logical inference. The second argument is that China's silver imports are purely for industrial use, not for stockpiling. That's possible. But industrial demand alone doesn't explain a 76% increase in imports over 5 years, especially when solar exports have not grown at a comparable pace. Something deeper is going on. Argument 3 suggests China wouldn't be able to conceal massive silver stockpiles because everything must be reported. That's simply not accurate. China has repeatedly demonstrated its ability to quietly accumulate strategic resources without public disclosure. It did so for decades with rare earth elements. It's doing the same with gold, buying significantly more than it officially reports. Silver, in fact, is even easier to accumulate discreetly due to the smaller size of the market and the limited attention it receives. Argument 4 claims that if China were truly stockpiling silver, prices would already be much higher. That might seem logical at first glance, but consider this: silver has already climbed from $18 in 2020 to around $59 today. That's a 220% increase in 5 years. The revaluation is already underway. If the trend continues, we could see much higher levels ahead. Here's what I'm watching to track whether this thesis is unfolding. China's Treasury holdings monthly TIC releases. If holdings dip below $700 billion by the first quarter of 2026, that would strongly indicate further acceleration. Silver import data from Chinese customs. Continued monthly imports exceeding 600 metric tons would reinforce the accumulation narrative. Silver export restrictions, industry observations. Any broadening of these restrictions or transition to formal policy would signal strategic intent. Tensions around Taiwan, geopolitical signals. Increased military activity would further support the theory that China is preparing economically for future confrontation. Silver market behavior. A sustained breakout above $65 would imply that markets are starting to factor in Chinese demand. A move above $70 would strengthen that belief. And a surge past $80 would serve as strong validation of the entire scenario. Now, Let's look at the real-world consequences. If this thesis holds up, if China is indeed selling treasuries to purchase physical commodities, particularly silver, several critical implications follow. First, treasury yields could remain elevated. With China stepping away as a major buyer, the U.S. will need to attract other purchasers, which may require higher returns. That puts pressure on the dollar. Second, silver's price behavior could diverge from typical economic cycles. Many analysts still view silver as a purely industrial metal that moves with economic activity. But if a government actor is absorbing supply for strategic reasons regardless of price, it begins to act more like gold, a reserve asset with long-term value. Third, any price spike could be abrupt. If China concludes its buying phase and reveals its stockpile or formalizes export bans, the silver market could react violently. We could see a jump from $70 to $100 in a matter of weeks, not months. Fourth, retail buyers may have limited time. At the moment, physical silver is still accessible, with premiums between $7 and $12 over spot. But if this narrative gains mainstream traction, premiums could double or triple eventually, leading to product scarcity regardless of price. That window may only last another 6 to 12 months. And one final point, China takes a long-term approach. It doesn't base its actions on quarterly profits. It strategizes in decades. Look at the Belt and Road Initiative announced back in 2013. It reflects how China positions itself far ahead of the curve. 12 years later, it's redefining the global flow of trade. The move to reduce U.S. Treasury exposure and ramp up commodity accumulation isn't a short-term reaction, it's a long-term, calculated strategy aimed at minimizing reliance on the dollar while boosting strategic independence. And silver plays a vital role in that vision. It functions as money, holding value during currency crises. It's a key industrial input, essential for manufacturing and technological advancement. It's dense and easy to store, unlike oil or food. And because the silver market is relatively small, China can secure a commanding position by allocating just a small slice of its reserves. From China's viewpoint, converting as little as 5% of its treasury holdings into silver gives it substantial influence over a vital resource. That's not just smart, it's strategic mastery. Meanwhile, the rest of the world is left reacting. I'm not here to tell you what actions to take. I'm here to show you what the data reveals. Over the past 18 months, China unloaded $127 billion in treasuries. During the same time frame, silver imports jumped by 29%. Export licenses for silver are being tightened. China is also the world's top solar panel producer, an industry heavily reliant on silver. They're getting ready for the possibility of future conflict with Western nations, which could involve financial sanctions and frozen dollar assets. Silver, in this scenario, is the ideal asset to quietly accumulate before global markets wake up to what's going on. If my analysis is correct, silver trading at $59 could be just the beginning of a much larger move. If China already holds even half the amount I estimate, they may control between 10% and 15% of the global silver supply. Once that information goes mainstream, the market could reprice violently. If you want to stay updated as this unfolds, follow along. I'll be tracking China's treasury positions via monthly TIC data, their customs-reported silver import numbers, and any official statements regarding strategic reserves. Do you believe China is quietly building a silver stockpile, or is this simply industrial buying? Share your thoughts below. This might turn out to be the most critical commodity story of the next decade, and it's already in motion. Time is running out.